The problems confronting Europe have pitted the world's biggest economies against each other. The G20 summit meeting in Mexico has so far been a forum for finger-pointing as non-European countries criticise the EU's handling of its debt crisis. In the meantime, the Greek election result has been overtaken by the potentially bigger problems of Spain and Italy. The latest Reserve Bank board minutes here showed Europe's problems were very much on the mind of policymakers when they cut interest rates this month. Here's finance correspondent Philip Lasker.
The G20, just one big happy family, at least for the photo shoot.
We are not coming here to receive lessons in terms of democracy or in terms of how to handle the economy, because the European Union has a model that we may be very proud of. We are not complacent about the difficulties. We are extremely open. I wish that all our partners were so open about their own difficulties.
Take note, non-Europeans like Barack Obama and others like Prime Minister Julia Gillard, who's been holding her government out to the G20 as the developed world's model economic managers.
I don't think it's going to come as any surprise to anyone that people are here talking about events in the Eurozone, me included, and many other leaders.
Some G20 countries are expected to pledge tens of billions of dollars in new loans to the IMF's pool of funds to protect borrowers like Spain and Greece. But talk now is not so much about Greece and its election result, but Spain and Italy, where bond yields are soaring to unsustainable levels. Spanish bond rates are at record highs, well above 7%, partly due to the €100 billion bank rescue plan, which was designed to shore up confidence.
At the moment, there is a concern on the part of investors in Spain that they don't want to lend money to Spain because they're fearful that if they do, they'll rank behind the European bailout fund if anything goes wrong in Spain. So consequently, that in turn is reinforcing this upwards pressure on Spanish bond yields.
And according to others, the absurdities don't stop there.
$100 billion is put up for the Spanish banking system, and 20% of that money has to come from Italy. And under the deal, the Italians have to lend to the Spanish banks at 3%, but to get that money, they have to borrow on the markets at 7%. It's genius, isn't it?
Genius or otherwise, it's this uncertainty that keeps Australians on edge and the Reserve Bank on alert. The latest Reserve Bank board minutes contained the telling comment that this month's decision to cut interest rates was a finely balanced one.
I suspect that it was really the non-Reserve Bank board members who were arguing for the cut, whereas you probably would have found that the Reserve Bank officials were actually a lot more sanguine and therefore more inclined to leave interest rates on hold.
Whether it's Martin Place or Mexico, there's no escaping the heated debates behind closed doors.